Hello and welcome to AI Market News by LM. Well, things have really escalated in the Middle East. A major conflict has just exploded onto the scene, sending some serious shockwaves through the global markets. And it's raising a huge question. Are we about to see $100 oil again? The situation is moving fast, so in this explainer, we're going to break down exactly what is going on and what it all means for the economy.
Alright, so here's what we've got on tap. First, we'll get into the military conflict that's kicking off this oil shock. Then, we're going to track the wild ride across global markets and see how that compares to the surprisingly steady US economy. After that, we'll look at how currencies and bonds are taking the news. And finally, we'll peek into the week ahead.
So first up, the conflict itself. And let's be clear, this isn't just some minor skirmish. This is a really big deal with consequences for everyone.
And you know, the severity here it's pretty stunning. We're seeing reports that a US submarine actually torpedoed an Iranian warship. Now get this, that's the first time a US sub has used a torpedo against an enemy ship since World War II. In response, Iran has reportedly unleashed a new wave of missiles and drones, and the whole conflict is just getting wider.
And of course, here's the immediate result. The oil markets, well, they didn't waste any time reacting. Brent crude, which is the big international benchmark, just shot up to $85 a barrel. At the same time, West Texas Intermediate, the US benchmark, jumped to almost $78. The market is clearly worried about a major supply disruption.
So, how is all this playing out around the world? Well, the shockwaves aren't hitting everywhere the same way. It's really creating a tale of two very different market reactions.
Over in Asia, the reaction has been, a total roller coaster. We've seen some absolutely extreme swings, especially in those markets that really depend on energy imports.
And just look at the scale of the panic here. Take South Korea, a country that imports a ton of its energy. Its main index, the Kospi, had its worst one-day drop ever. It plunged an unbelievable 19.5%. Just a historic sell-off, all driven by fears of what a bigger war would do to their economy.
But then, and this is the crazy part, the very next day, it snapped right back, surging 12%. Analysts are saying this wild whiplash was likely caused by a massive unwind of crowded leveraged bets. Basically, traders who were forced to sell in a panic had to scramble to get back in.
Meanwhile, all the way across the Pacific, the picture was just dramatically different. While Asian markets were on this insane ride, US markets seemed almost calm, kind of detached from all the chaos. So what gives? What's behind this split?
And that brings us to this powerful counterstory that's propping up the US markets, a domestic economy that's proving to be surprisingly strong.
You know, right now, the market is basically in a tug-of-war. On one side, you've got this massive pull of geopolitical fear, the risk of war, spiking energy prices, all pushing investors to sell. But pulling just as hard on the other side is some really strong economic data here in the US, especially from the services sector, which is showing great activity and cooling inflation.
And we can see this resilience right in the numbers. Despite everything going on in the world, all three major US indices closed up for the day. The S&P 500 gained nearly 0.8%, and the tech-heavy NASDAQ actually led the pack, up almost 1.3%. For now, it looks like economic strength is winning the day.
And we're not the only ones noticing this. Goldman Sachs CEO David Solomon said something similar. He mentioned that even with all this uncertainty, the market's reaction has been pretty benign. He thinks people are just waiting for more information before they make any huge moves, keeping an eye on economic growth and energy supply chains.
So, to get a better handle on this calm mood, we can actually look at a tool like the CNN Fear and Greed Index. It's pretty cool. It tracks 7 different indicators to figure out if fear or greed is the main emotion driving investors. It's a great little snapshot of market sentiment.
Okay, so stocks are holding up, but what about the other corners of the market? Let's take a look at how currencies and bonds are putting all this conflicting information together.
The bond market, well, it's telling a bit of a different story. Yields on the 10-year US Treasury have been creeping up. And when yields go up, that means bond prices are falling. It's a signal that bond traders are getting worried that this whole oil shock is going to reignite inflation down the line.
Over in the currency markets, we saw a classic flight to safety. The US dollar shot up at first as investors looked for a safe place to park their cash. But as US stocks held their ground and some of that initial panic started to fade, the dollar has pulled back a bit.
And of course, all this brings the Federal Reserve right back into the spotlight. We can keep tabs on what the market thinks the Fed will do by using the CME Fed Watch tool. It looks at futures prices to figure out the odds of an interest rate change. And with inflation fears back on the table, this tool is definitely one to watch.
So, what's next? To wrap things up, let's look at the key events we should all have on our radar in the coming days.
So based on the economic calendar from investing.com, the next really big piece of data for the US is the initial jobless claims report on March 5th. This one's super important because it gives us a fresh look at the health of the job market. We'll also be getting updates on labor costs and factory orders, which will fill in more of the economic picture. And that really leaves us with the one central question that's hanging over everything. We're watching a standoff between a strong, resilient economy and a spiraling geopolitical crisis. The great unknown is which one of these powerful forces is going to win out and dictate where the market goes from here.
This video is automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.